When people talk about the greatest investors in modern history, Ray Dalio is always part of the conversation. He is the founder of Bridgewater Associates, one of the largest hedge funds in the world, and he is known for his unique way of thinking about money, risk, and life itself. But while his strategies often involve billions of dollars, Ray Dalio has also shared simple principles that even beginners with just $1,000 can apply. Today, I am going to break down his $1,000 investment principle in a way that anyone can understand and show you how it can completely change the way you think about building wealth. Ray Dalio believes that the foundation of smart investing is not about chasing high returns, but about managing risk. He often says that the number one mistake investors make is believing that what happened recently will keep happening. In other words, most people get too optimistic during booms and too pessimistic during crashes. Dalio's principle is about creating a system that protects you in any market condition, whether the economy is booming, stagnating, or collapsing. So, what is the $1,000 principle? At its core, it is the idea that even with a small amount of money, you can apply diversification and balance, the very same strategies used by billionaires to grow wealth safely. Dalio insists that beginners should not think about getting rich overnight. Instead, they should focus on protecting themselves from risk while still capturing long-term growth. The way Dalio explains it, your goal should be to build a portfolio that works like a machine. This machine should not depend on predicting the future, because nobody can predict the future accurately all the time. Instead, it should be designed to survive different economic seasons. Dalio describes four main conditions: inflation, deflation, rising growth, and falling growth. If your portfolio is designed to handle all four, then no matter what happens, you will be protected. Now let us break this down into steps that a beginner with $1,000 can follow. The first step is diversification. Ray Dalio famously says that diversification is the only free lunch in investing. What he means is that by spreading your money across different assets, you reduce risk without necessarily reducing returns. Imagine you put all $1,000 into a single stock. If that company fails, you lose everything. But if you spread that money across different stocks, bonds, and even commodities, the risk is balanced. Dalio often compares diversification to having multiple bets in a casino. If you only bet on one number in roulette, you will probably lose. But if you spread your bets across many numbers, your chances improve. The same is true in investing. Diversification smooths out the ups and downs. The second step is asset allocation. This is the heart of Dalio's principle. He created something called the all-weather portfolio, which is designed to work across all economic seasons. While his exact portfolio is complex, the simplified version for beginners can be broken into four parts. Around 30% in stocks for long-term growth, around 40% in long-term bonds for stability and protection during recessions, around 15% in intermediate bonds for balance, around 7.5% in gold, and 7.5% in commodities for protection against inflation. Now you might be thinking, how can someone with just $1,000 follow this? The answer is through index funds and ETFs. Instead of buying individual stocks or gold bars, you can use funds that represent these asset classes. For example, one low-cost index fund for stocks, one bond ETF for long-term bonds, one bond ETF for intermediate bonds, and one gold ETF. By dividing your $1,000 across them in the proportions above, you are essentially applying the same principle that Dalio uses at the billionaire level. The third step is rebalancing. Dalio explains that markets move, and over time your allocation will drift. For example, if stocks rise quickly, suddenly they might represent 40% of your portfolio instead of 30%. That makes your portfolio riskier than intended. The solution is to rebalance. Sell a little of what has grown too much and reinvest into what has fallen behind. This keeps the portfolio balanced across different conditions. The fourth step is patience. Dalio says that compounding is the eighth wonder of the world. Even small amounts of money invested consistently and left to grow can become large sums over decades. The mistake most beginners make is pulling money out too soon or chasing the latest hot trend. His advice is clear: create a balanced system, stick to it, and let time do the work. Now let us explore what happens if you actually apply this $1,000 strategy in real life. In the first month, you may not see dramatic results. The portfolio might move up or down a little depending on the markets. But the important thing is that you are no longer guessing. You are not gambling on a single stock or trying to time the market. You are following a disciplined system. This is the difference between a beginner investor and a gambler. Over the first year, the power of balance starts to show. If stocks crash, your bonds and gold will likely rise, softening the blow. If inflation spikes, your commodities and gold protect you. If growth returns, your stocks carry the portfolio higher. No matter the condition, part of your portfolio is always working for you. This reduces stress because you know you are not relying on luck. Over 5 years, if you keep adding small amounts, say another $100 each month, the effect becomes even more powerful. Instead of just $1,000, you may have several $1,000s working in a balanced machine. The compounding effect begins to take shape, but here is the real secret behind Dalio's principle. It is not only about the money, it is about psychology. Most beginners fail not because they pick the wrong stock, but because they panic, chase trends, or give up during downturns. By following a principle-based system like this, you train your mind to stay calm. You stop reacting emotionally to every market swing. That discipline is worth more than any hot stock tip. Dalio also emphasizes that learning is part of the journey. He says you must always be a student of markets and life. So while applying this strategy, I also committed to studying investing basics. I read books, watched educational videos, and followed financial news. Over time, the strategy was not just growing my money, it was growing my understanding. That knowledge itself is an asset. Of course, some people argue that $1,000 is too small to matter. But Dalio would disagree. He says the habits you build with small amounts are the same habits that will serve you when you manage larger amounts. If you cannot manage 1,000 wisely, how will you ever manage 10,000 or 100,000? The point is not the number, it is the discipline. Another key lesson is humility. Dalio always admits that he cannot predict the future. That is why he designs systems that do not rely on prediction. Beginners often fall into the trap of thinking they can outsmart the market. Dalio teaches the opposite: accept that you cannot know everything, and build a portfolio that works even when you are wrong. This humility is what protects you in the long run. After applying this principle myself, here is what I noticed. My stress around money dropped dramatically. Instead of constantly worrying about whether I picked the right stock, I felt secure knowing my money was spread across different conditions. Even when markets dipped, I did not panic because I understood the balance. And when markets rose, I felt confident that I was capturing growth without taking reckless risks. Over 30 days, I did not become rich. That is not the point. But I became an investor, not a spender. I created a small machine that can keep growing if I feed it, and I built habits that will scale as my income and savings increase. That is the real power of Dalio's $1,000 principle. So what is the takeaway for beginners? First, start small but start now. Waiting until you have more money is just an excuse. Second, use diversification and allocation to protect yourself from risk. Third, rebalance when needed and be patient. Fourth, keep learning and stay humble. If you do this, you will already be ahead of most people who never move beyond guessing or gambling. Ray Dalio once said that he designed his portfolio to survive and thrive across all conditions because he knows he cannot predict the future. That is wisdom for anyone at any level. With just $1,000, you can apply the same principle and set yourself on the path to long-term wealth. And maybe that is the most empowering part. Wealth building is not about having millions to start with. It is about starting with what you have, building discipline, and letting time multiply your efforts. Ray Dalio's principle proves that anyone, even a beginner with just $1,000, can invest like the best.